A basketball team can lose money every single season and still make its owner hundreds of millions richer. That's not a loophole. That's the entire business model. Most people picture team ownership as courtside seats and a trophy case, some kind of rich person's hobby that happens to throw off cash. It's not a hobby, and it's barely even about the sport. Billionaires aren't fighting over these teams because they love watching games from a better seat. They're fighting over a financial structure most fans never think to question, and the actual mechanics of how this business makes its money would surprise almost everyone watching from the stands. Sports franchises are one of the strangest asset classes in the entire American economy. In the past few years, marquee franchise sales have shattered records again and again, with the Boston Celtics selling for a price that made it the largest sale in NBA history. The Washington Commanders sold for roughly $6 billion, another record at the time for an NFL team. Team values have climbed so fast that a franchise bought for a few $100 million 2 decades ago can now be worth well over $1 billion. So how does an industry where most teams don't even turn a profit from ticket sales alone produce this kind of wealth? That's what this video is going to answer, and the answer has almost nothing to do with what happens on the field. Let's start with why the price tag doesn't make sense on paper in the first place. When analysts run the numbers on a team sale using a normal business valuation, a discounted cash flow analysis based on the actual revenue the team brings in, the number they get is often far below what the team actually sells for. That gap isn't a mistake, it's scarcity. There are only 30 or so franchises in each major league. Ownership almost never turns over, and when a marquee team finally does come up for sale, buyers know that if they don't get it now, they may never get another chance at all. That single dynamic pushes prices past what the underlying business alone would ever justify. And it's exactly what happened in the record-breaking Celtics and Commanders sales. Now here's the part almost nobody outside the industry understands. The tax code treats a sports franchise almost nothing like it treats a normal business, and the difference is enormous. Under current law, owners can amortize the value of a team's intangible assets, things like media rights, contracts, and trademarks, over 15 years. That means a huge portion of the purchase price becomes a tax deduction spread out over a decade and a half, even though those assets aren't actually losing value. In fact, media rights and franchise value are usually climbing the entire time the owner is writing them off. On top of that, owners can also depreciate the physical assets that come with the deal: the stadium, the facilities, the equipment, and even claim bonus depreciation to accelerate a huge chunk of those deductions into the very first years of ownership. One team president once put it bluntly, that under the accounting rules, a franchise can turn a real multi-million-dollar profit into a reported loss, and get any accounting firm in the country to sign off on it. This is the mechanism sports finance people sometimes call the ultimate tax shelter disguised as a hobby. An owner can be collecting real cash from ticket sales, media deals, and sponsorships every single year, while their tax return shows a loss, because the deductions from amortizing and depreciating the deal are large enough to offset the actual income the team generates. For a billionaire already paying enormous tax bills on their other businesses, owning a team isn't just a prestige purchase. It's a financial tool that can shelter income from an entirely different part of their empire. There's also a public money angle that almost never gets discussed alongside the tax benefits. Many stadiums are built or renovated using significant public financing, taxpayer-backed bonds, tax exemptions, and direct subsidies from cities desperate to keep or attract a team. Owners get a private asset that appreciates for their own benefit, while a meaningful chunk of the physical infrastructure underneath that asset was paid for by the very taxpayers who then buy tickets to watch games in it. Economists have studied this for decades, and the consensus is almost unanimous. These public stadium deals rarely pay for themselves in local economic activity, and yet cities keep signing them because the alternative is watching the team, and the prestige that comes with it, leave for another city willing to pay. So who's actually allowed to buy in, and how has that changed recently? For most of professional sports history, this was an extremely closed club, a handful of families and individual billionaires with enough liquid capital to buy a controlling stake outright, full stop. That's changed fast. Nearly every every major league, the NBA, the NFL, the NHL, MLB, and MLS, has opened the door to institutional investors, private equity funds, buying minority stakes in teams. The NBA currently allows a single private equity fund to hold passive stakes in up to 8 different franchises, and nearly 2/3 of NBA teams now have some connection to private equity money. The NFL, historically the most locked-down league in the country, only started allowing this in 2024, and even then capped institutional ownership at just 10% of a team, with a minimum stake size of 3%. Firms like Arctos Partners and Ares Management have become some of the most active buyers of these minority stakes across nearly every major league at once. These minority stakes come with strict guardrails. Institutional investors get no governance rights and no say in how the team is actually run. They're purely financial positions, a way for a fund to get exposure to an asset class that keeps appreciating at a rate almost nothing else in the economy can match, without the fund ever touching a single football or basketball decision. For the existing owners, it's also a quiet liquidity tool, a way to cash out a portion of a team's value, fund a renovation, or bring in fresh capital, all without giving up control of the franchise they built their name around. Let's talk about where the actual money comes from once you're in, because it's almost never mainly the ticket. Media rights are the biggest single driver of modern franchise economics. The NBA's current national media deal is worth $76 billion over its term, more than double the average annual value of the previous package, and it alone is projected to hand each team an average of roughly $200 million a season before a single ticket is sold. Add in each team's local and regional media deals, and media revenue alone can dwarf what a team makes from actually filling seats. Then there's the layer most fans never think about at all: sponsorship and naming rights deals, stadium-adjacent real estate development, parking, concessions contracts, and merchandising licensing, all of which get spread across the ownership group in ways that keep compounding as the league's overall media value climbs. A team doesn't need to win a championship or even make the playoffs for these revenue streams to keep growing year over year, because they're tied to the league's overall media and brand value, not to any single season's win total. Women's sports ownership has quietly become one of the fastest growing corners of this entire market. WNBA expansion franchise fees have climbed into the hundreds of millions of dollars for new teams entering the league, a number that would have sounded absurd just a few years earlier. And it reflects the same scarcity and media value dynamics driving every other league, just arriving later and compounding faster. Let's look at one specific case, because the numbers make the whole pattern click into place. Steve Ballmer bought the LA Clippers in 2014 for $2 billion, a price that seemed almost reckless at the time. Some analysts called it an overpay by hundreds of millions of dollars. Just over a decade later, that same franchise is valued at multiple times the original purchase price. Ballmer didn't need the team to win a championship for that to happen. He needed the league's media deals to keep growing, the scarcity of available franchises to stay intact, and time to pass. That's the entire playbook, laid out in one purchase. Then there's a revenue stream most fans have personally paid into without realizing how it works. Personal seat licenses, the upfront fee some teams charge just for the right to then buy season tickets, on top of the season tickets themselves. These licenses can run into the tens of thousands of dollars per seat in premium markets, and they're often financed the same way a mortgage is, locking fans into paying for access years before a single game is played. It's a revenue stream that exists entirely because of scarcity too. There are a fixed number of good seats, and teams have learned they can charge twice for the same seat, once for the right to buy it, and again for the ticket itself. So what does all of this actually mean for someone trying to get into this business today? The barrier to entry for full ownership is almost incomprehensibly high now. A marquee franchise in a major league can run well over $1 billion, sometimes several billion, and that's before financing costs, league approval fees, and the debt covenants most leagues require owners to meet. For anyone without 9 or 10 figures in liquid capital, full ownership simply isn't realistic anymore, which is exactly why the minority stake and private equity pathway has exploded the way it has. It's the only door still open to serious capital that isn't already a billionaire's personal fortune. There's also real political risk layered on top of all of this. The tax treatment that makes these deals so attractive has drawn direct scrutiny from Washington, with policy proposals specifically targeting the amortization benefits that wealthy owners rely on, including bills introduced in Congress aimed directly at eliminating the tax break for sports team owners. So far, those proposals have been excluded from major tax legislation, and existing owners have largely kept their full benefits intact. But it's a signal that the loophole isn't guaranteed to last forever, and any serious investor in this space has to factor in the possibility that the tax advantage, not just the team's win total, could change under a future administration. It's also worth remembering this asset class isn't purely one-directional. Regional sports network deals, once one of the most reliable revenue streams in the industry, have started cracking under the weight of cord cutting, with at least one major regional sports network operator filing for bankruptcy in recent years. Leagues and teams are scrambling to replace that lost stability with direct-to-consumer streaming deals, and how that transition plays out over the next decade will meaningfully shape franchise values going forward. It's not guaranteed to be smooth for every market. So after the scarcity premium, the tax shelter, the media rights, the public financing angle, and the increasingly complex ownership structures, what does this actually pay out? For a controlling owner of a marquee franchise, the return isn't really measured season to season. It's measured in the appreciation of the asset itself. Franchises that sold for a few $100 million a generation ago are now worth well over 10 times that, an appreciation curve that dramatically outpaces almost any other asset class available to the ultra-wealthy, all while the tax code lets much of the ongoing operation report as a loss. For the private equity funds now buying in at the minority level, the return looks different. A passive, long-term bet on an asset class that keeps climbing in value with almost no correlation to the stock market, backed by media deals that are contractually locked in for years at a time. Compare that appreciation curve to almost any other asset a wealthy family might hold. Real estate in a strong market might climb steadily over decades. The stock market has historically returned somewhere around 7 to 10% a year on average, with real volatility along the way. Sports franchises, by contrast, have posted some of the strongest and most consistent long-term appreciation of any asset class tracked, largely because the supply of teams never meaningfully increases, while the pool of people wealthy enough to want one keeps growing every year. That mismatch between fixed supply and rising demand is, in the end, the simplest explanation for why these prices keep climbing, regardless of what happens on the scoreboard. So, is it worth it? For someone without 10 figures of liquid capital, this isn't really a business you can walk into at all anymore. It demands access most people will never have, a willingness to navigate exactly the kind of political and tax risk that federal policymakers are actively circling, a level of scarcity in the market that keeps pushing prices further from what a normal valuation model would ever justify, and exposure to a media landscape that's shifting faster than at any point in the industry's history. But for the small handful of people who can actually get a seat at this table, this becomes one of the most quietly lucrative assets in the entire American economy, appreciating for decades, sheltering income from other parts of an empire, and requiring the team to do almost nothing on the field to keep paying off. The trophy in the case was never really the asset. It was the 15-year tax deduction sitting quietly underneath it, appreciating in value the entire time everyone else was watching the scoreboard.